Hi, I'm Pattu from FreeFinCal. Today let's talk about DSP US Flexible Equity Fund. This fund is a open-ended fund of fund that invests in BlackRock Global Fund's US Flexible Equity. The scheme was launched in August 2012 when DSP and BlackRock were together in the Indian market. Then BlackRock left. The fund only has an AUM of about 474 crores now, and the word flexible in the underlying fund, that is the US flexible equity fund from BlackRock Global, essentially means that the fund manager can either choose a value investing kind of approach or a growth investing kind of approach depending on the market outlook. And that fund has a mandate to invest 70% of its assets in the US equity, and it's benchmarked to the Russell 1000 Total Returns Index. Russell 1000 Total Return Index is basically 1000 top funds by market capitalization in the US market. Is basically a benchmark large cap index. S&P 500 is half this universe. This is 1000 stocks. Now, this fund has got the top 10 holdings of the fund are shown here. It's got Microsoft almost 6%, Alphabet 5.8%, Amazon 5%, Apple 4%, Visa 3%, etc. The usual suspects in the top 5 list. Then it's got Applied Materials, United Health, Comcast, General Motors, etc. Now, the underlying underlying fund's expense ratio is 0.78%. On top of that, additionally, there will be a 0.85% for the direct plan. Now, I don't understand this logic. Now, the underlying the fund manager is the guy who is actually selecting the stocks. They themselves, because they are an institutional fund, they themselves are charging only 0.78%. DSP is basically going to take our money and just basically invest in that, and for that they are charging an expense ratio higher than that of the underlying fund, which is amusing. So 0.78 plus 0.85 is what we will be charged effectively, and the regular plan will get 0.78 plus 1.68% because of the commissions. These are absolutely atrociously high numbers, especially if you consider the performance of the fund. Now, one person asked me whether this fund is better than S&P 500 index fund because it is benchmarked to the Russell 1000 index, and because it is that can be a little more diversified. The truth is because of the market capitalization weighting of the index, there is not much of a return difference between the S&P 500 and the Russell 1000. The pink line is the 5-year rolling return of the S&P 500. The yellow line is the Russell 1000 corresponding data. There's not much of a difference over 5 years. There's not much of a difference over 10 years as well. So there's nothing special about Russell 1000. You don't need to invest in DSP flexible equity fund because of Russell 1000. There's nothing special there. Now, if you look at the 7-year rolling returns of the fund, that is the underlying fund, everything is in USD. The brown is the BlackRock US flexible equity, and the yellow line is the Russell 1000. You can see that the brown line has always been lower than the yellow line over 7 years. So over 7 years, the fund manager has barely has not bet at all, in fact, I would say. Then over 5 years, except for the last 1 or 2 months, the fund has underperformed even over 5 years. Now, when the underlying fund itself is not able to outperform, then you are going to add your own expense ratio, the local AMC's expense ratio. Then what is the point in investing in this fund? Again and again, I keep saying, please, if you want US equity or international exposure, please stick to Motilal S&P 500 index fund. As of now, that is the only fund I can think of that is justified if you want such exposure. Of course, I have to look carefully into the tracking error of the Motilal S&P 500 index fund. I will do that in a separate post. Now, I have already reviewed in previous videos several international fund, Mirae Fang, ICICI Blue Chip, Franklin US Feeder, Axis Global Innovation, Axis Global Equity Alpha, US Greater China, Edelweiss US Technology, Edelweiss Greater China. Please go look at all these. There is a very common thread that is there among all these kind of funds. Everything, if a Indian fund of fund is going to invest it in a active fund, it is I would say a double waste of money, because the active fund itself, the underlying active fund itself, is struggling to beat their benchmark. They will say they don't have a benchmark. That is even worse if you read the prospectus properly. Then there is on top of that, there's an atrociously high charge. Forget the commissions. Even for the direct plan, there's atrociously high TER charged by the Indian AMC. So why do you want to waste money in such fund of funds? Please avoid.